In our previous videos, we looked at a balanced scorecard. And in videos previous to that, we looked at financial ratios. So all of this, comparing a standard, so an industry standard in terms of financial ratios to where we're currently at, and putting all of that on a balanced scorecard, or maybe it's not just financials, but we are looking at other performance-related issues in terms of, are we satisfying our customers? How productive are we? So as our process, we could look at improving safety. We could look at productivity. We could look at costs, all these components, looking at the performance of our organization and our processes within it. So all of this is part of a control cycle. So a control cycle is the process of monitoring activities to assure they've been accomplished as planned and allowing us to correct any significant deviations. So we measure our actual performance. That would be things like calculating productivity, which we did in previous videos, or calculating our gross margin or our profit margin, or calculating our financial ratios. How are we doing? Comparing that to a performance standard, the benchmark. Either that's how well we did in the past. Are we improving? That's comparing it to the industry. So we could use that Industry Canada data. And then how acceptable are we in terms of variation? How far off can we be? So we want to measure the actual, compare to a benchmark or standard, and then figure out what actions we should take. We could take what we call basic corrective actions. This is we focus on the source of the problem and try to fix the problem at the source. So if we are looking at, in terms of our gross margin, how well we're doing, so revenue minus cost of goods sold, and we're finding that that gross margin is low. What is the cause of that? Well, maybe there is an issue in our production process where, so if we're looking at our gingerbread houses that we've been making, for example, if the choices we made in terms of the process is inefficient, so it takes our workers longer to make one unit, and if we are using a lot of frills in our decoration of our gingerbread house that doesn't translate into a higher value we can sell it for, then we need to focus on the source of those issues and streamline the production process, streamline the design. That's going to be that basic corrective action. Focusing on the source, preventing it from the future. Alternatively, we could look for immediate corrective action. So this here focuses on the outcome instead of the source of the problem and says, okay, the problem's already occurred, we just need to fix it. So let's suppose that in terms of customer satisfaction, what we are finding is that our customer satisfaction score, we survey the customers in terms of how happy they are with our product. We want to be a 4 out of 5 on that scale. We are currently sitting at a 2. Well, basic corrective action would be to go back and figure out what that cause is that created the unhappy customers and fix it for the future customers. But immediate corrective action is remedying the outcome for those unhappy customers. So they gave us a low rating. What can we do now to fix it? So can we recall or take back the item that we sold them and tweak it, fix it so that the customer is satisfied? So it's focused on the outcome. We are fixing the product afterwards to improve that score. But it's not based on planning for the future and doing it right the next time. It's about remedying the one that already went wrong. So fixing the product that the customer is unhappy with so that the score they're giving us doesn't reflect how they feel. So in terms of the control cycle, we have goals, we have standards, we measure that actual performance, we compare it to a standard. Are we obtaining the standard? If we are, no worries. If not, maybe we're not at the standard, but are we within an appropriate amount of distance? So are we good enough, close enough to the standard? And so if we are, then we're good. Don't worry about it. If we are far outside of where we need to be, we're not anywhere close to the standard, then we need to look at, is that standard reasonable? If it is, we need to fix the problem. We need to then either remedy the issue with immediate corrective action, and we need to create a plan to fix whatever's causing the problem so that it doesn't happen again with our basic corrective action. If the standards are not acceptable, maybe our goals are not realistic, we need to go back and revise the standard. So what are we using as our benchmarks, and are they realistic for where our organization is at? When it comes to control, you can fix the issues in terms of the input, so we can anticipate the problems before they happen and deal with them early on. We can correct the problems as they are happening during the process. Or, as we said, we can take that corrective action in terms of after the problem has occurred, can we fix it? So if we go back here, can we take that immediate corrective action in terms of satisfying the unhappy customer after we've already made the good or provide the service? So control can take place at the beginning, in the middle, and at the end. The key to remember is it gets more costly the closer you are to the customer. So fixing something after the fact, if we think about cars, if we have to recall the vehicles, if we have to pay court fees because someone got injured, if we have to then win back our customers because they don't like us anymore, that is all a lot more costly than if we can fix the defects before they happen or remedy the issue while it's happening. So it becomes more and more costly the further we are through this process. So when we talk about these controls, where do we get the controls when it comes to financial controls? So we have our ratio analysis, right? We can compare to those financial ratios, industry versus current. We can do a budget analysis, so we can compare in terms of how many resources we're using, how work is being allocated, ultimately in terms of how much revenue versus cost. There are two other financial controls we want to look at. One is called economic value added. Economic value added is a financial tool that measures corporate and divisional performance. When we look at economic value added, we take operating profit. So what's another word for operating profit? We have operating income. We also have earnings before interest and taxes. So economic value added takes the earnings before interest and taxes, or EBIT, and subtracts the taxes from it and subtracts the interest from it. And what is left is the economic value added. So the question here is the company generating value from the funds that are invested into the organization. And if you have a negative EVA, then you're not generating value from the investments into your organization. So we want an EVA that is positive. We want to generate value. And if we have an increasing EVA year after year, it's going to lead to an increasing MVA. So MVA being the market value added. The market value added is a stock market's estimate of the ability to increase shareholder value over time. So to find the market value added, we add common stock, right? So here's our investors, plus liabilities, so all of our debt, subtract the cash on hand, okay? So this is our wealth that we've created. So here we have the wealth that's been created. And we have funded that wealth either from investors or from debt. And if we subtract from that wealth that is created the initial investment into our organization, how much we put into it to start up, that looks at, are we creating wealth? If you have a negative MVA, then your management is destroying wealth. Okay, so we want to know, do we have a management that is creating wealth? We want a market value added that is going up. And as we said, if we have consecutive years of economic value added, then it's going to lead to growth in your market value added.